Hey everyone, today I've got an exciting topic that I want to share with you. This is hopefully the first of a series of videos talking about starting your own insurance company using options. Okay, so I'm currently building an online course to teach people basically this strategy of starting your own insurance company. And the strategy hinges around bull put spreads. So if you don't know what a bull put spread is, you can Google it, you'll find out. But I'll go over that really quickly in this video. So on my screen, you can see I've already started implementing this strategy. And so I created an account where I initially started with, I think it was, roughly $9,000 in this account. And so far, year to date, I've got profits of almost $3,000. And so the net liquidation value now of my account is about $2,000. You can see up here, or $12,000, sorry. So with this strategy, I've already been able to grow the account by a couple $1,000s just trying this out. And I think there's still room for optimization and for improving how it works. But I'll show you some simulations in just a minute that I ran in Excel to see what maybe realistically, what type of returns could be generated from this type of strategy after taking into account your losses, of course, right? So the net profit. So we'll get to that in just a second. But so I want to show you on my screen, and this will help kind of you understand the concept of what I'm trying to teach here. So bull put spread, you can see, for example, I've got this Match.com option. This is a bull put spread. So I sold a 130 put, that's why it's -1 quantity, and I bought a 125 put, that's why it's a +1 quantity there, right? So simultaneously selling and buying. For those of you who don't know what a put option is, I would encourage you to go just Google that and do some research. We're not going to cover those basics in this video. But essentially, when you sell a put, you are insuring the stock price on that particular underlying security or stock, right? So when I sell this 130 put, I am agreeing to essentially buy the stock from someone at $130 a share. So somebody can put those shares to me for $130 anytime before expiration of this option contract, which happens to be, so this is the May 21st, 2021 contract. So anytime before May 21st, 2021, the person who bought this put from me can say, hey, I want you to buy my shares, and each option contract is for 100 shares. So they could say, I want you to buy my 100 shares from me for $130. Now, why would somebody do that? Why would somebody put that to me and say, pay me $130 a share? Well, only if, somebody would rationally only do that if the stock price was trading below $130, right? So, in essence, when you sell a put option, you are providing insurance. You're providing downside protection to the person who bought it from you. So you're providing protection below $130 a share. So if the stock price drops, that individual who owns 100 shares of Match won't lose money because you are essentially covering the losses below 130. Now, what do you get in exchange? So when I sell this 130 put, I don't take this risk on for free. Just like any insurance company, right? They're not going to take the risk of whatever liability might happen, whatever accident, if it's car insurance, whatever damage from an accident that might occur to your vehicle or to people in the accident. They're not taking that on for free. They want to be paid a premium, right? And so an insurance premium. So when I sold this, I collected $895. It's always in quantities of 100, so you got to multiply that 8.95 by 100. So it's $895, right? And I could have just left it at that. I could have said, all right, I'm going to insure your stock for $130. And if it drops below, you're probably going to say, here's the contract, buy my shares for $130, and now you own the shares for, I would own the shares at that point. So that's the difference, though, where this type of insurance company is better than your typical insurance company, because even if you get put the stock, there's a claim made, right? Somebody puts you the stock, you still actually would have some asset in return. So it's not like you're just paying out $130 and getting nothing in return. You would still get 100 shares in exchange for that. So maybe that's trading at $120, and you had to buy it for $130. You still have an asset worth something. So that's just as a side note. It's better than the typical insurance industry because you actually have an asset with some value at the end after the claim. You're not just paying out pure cash. You're getting something in exchange for it. So, so I could have just left it at that. But I don't want to take on that much risk because theoretically, the stock could go to zero. $130 stock going to zero. That means I would have to pay $130 to this person for those 100 shares. And if those shares are worth zero, I would theoretically lose a lot of money. 130 times 100, which would be $13,000, right? And so I say I don't want to take on $13,000 of potential risk. So like a lot of insurance companies, what do? You go and you buy some reinsurance. So I could go into the market and I could buy a 125 put. So now somebody else is going to take the risk below 125. So now I'm just taking the risk below 130. Down to 125. After 125, I'm out. That's the extent of my losses. So if you do the math, there's a $5 spread between these strike prices. That means my max risk I'm taking on is $500. $5 times 100, right? So the most I can lose is $500. But, and let me go back, and I did pay $6.70 for this 125 put. So I had to pay the reinsurer essentially $670. So I took an $895. I spent $670 of that for this reinsurance. So the difference was $225, right? So I collected a net $225. I said my max loss is $500. Well, my net max loss is going to be the $500 minus the $225 in premium I received. So my real max loss is $275. So $275. So I can lose $275. Now, let's go over to this chart. I've got match up here. So I put on this trade on this day a couple days ago when match was trading around the 130 level. Right? So I drew this line in the sand and said if match is above 130 upon expiration, which was out May 21st, right? So right about here on this chart, ignore this volume at price analysis over here. So right around here, so I've got to wait until we get there. If we're above this line, stock price is somewhere in here, up just anywhere above this line, then that premium I received, that net premium of $225, I would get to keep that. The options would expire worthless. I would get to keep that. That would just stay in my account, my brokerage account, right? If it's trading below 130, let's say it went down here to 123, or even down here to $80, right? Doesn't matter. If it's below 125, then I would just lose $500, but minus my credit, my credit of 225, so really 275. So I lose $275 if it was below that 125. And really, if it's below like 127.75, I would lose my $225. So I don't want it to be below this price. So when I'm selecting which stocks to write insurance on, right? When I'm doing my underwriting, I'm looking at charts first to see if there's some support at a certain level. And when I looked at this, it looked like there's historically, we kind of bounced off 130 level, came down, bounced off 130 level. Now it looks like we're bouncing off the 130 level again. So that seemed like strong support. So you don't want to do this unless you can sell your insurance at a price, the strike price that you're selling is kind of solid support, right? That increases your chances. Now, the interesting thing is when they price options, when the stock was at 130 here, the way that the market is pricing options, it's assuming there's a 50-50 chance that the price will go up or down from this point. Well, I think based on the history and these support levels, that it's probably a better than 50% chance that we'll stay above that level. But interestingly, to your advantage, the market just assumes that it's a 50-50 chance. So that's one skew in your favor. And then what I also do, kind of another step, and as I develop my course to teach this, another step is to see what the fundamentals look like. If it doesn't look insanely overvalued, and there's some basis for that, for the valuation fundamentally at this level, then that bolsters my kind of confidence that we'll be above the 130 level on May 21st. And I did look, I use a tool called Finbox. It's at finbox.com, used to be finbox.io. I think either one of those URLs will get you there. It is a paid service, about $19 a month for their basic package. I'll try and include a link below, but and then I think you may get $5 off or something like that. But it's a good service, and it runs some different valuation models to tell you what it thinks fair value is. I think this one was above 130, slightly, not much. But at least it was above this 130 level as well. So that checks that kind of valuation box. And then you also want to be aware of upcoming earnings. So we do have potential earnings coming up before then, but I may close out this position before then. So that's just one brief example. Like I said, I think I've got 7 or 8 of these on that I've put on the last few weeks. And you can see so far, match after 2 days, I'm already up $111. That means now the price, if I was going to unwind this and buy back the put that I sold and sell the put that I bought, it would be less than that 225, and so my net, I would still get to keep $111 so far. So in just a few days, I've made about 50% of the max profit already, because as you can see, the stock had a good couple days and now is at 140.42. So these other positions I put on, so I think pretty much all of them are in the green, which is pretty good. And so I've got about $703 total profit from these 1, 2, 3, 4, 5, 6, 7, 8. Okay, so there's 9 trades. Some of them I just put on yesterday, I think, which, Home Depot. So this one's actually the opposite, where I'm selling a call because I think the stock will go down potentially. So you can play it both ways. So I'm trying to have a few that are bear call spreads, so that it kind of hedges a little bit. If the market goes down, I would hopefully win on those ones. So maybe 1 in 4 will be a bear call spread, but majority, since the market goes up most of the time, are going to be bear put spreads. Boeing, for example, and right now most of them are $5 wide spreads, and so they're pretty close to at the money. So I'll be collecting, when you're at the money, you collect about half the width of the spread for a premium. So somewhere from between $200 to $250.